All right, let's get right into it. Today, we're going to break down something fascinating and honestly, pretty dangerous. It's this pattern popping up everywhere, the great AI pivot. Look, this isn't just some passing trend. It's a playbook, a really old one actually. And by the time we're done here, you're going to have the framework to spot what could easily be the biggest exit scam of the next few years.
This quote, it just perfectly sets the stage, doesn't it? It's way more than a clever headline. It points to this huge thing happening in the market. Some people are calling it a liquidity trap. And what that really means is there's just a flood of cash everywhere, and it's desperate to find a home, to find any kind of return. And guess where all that cash is going right now? Yep, one place, AI. And that kind of desperation? Well, it's the perfect breeding ground for some, let's just say, very questionable corporate moves.
So, let me introduce you to our main case study for today. On the left, you've got Allbirds, right? The company famous for those comfy wool sneakers. Now look at the right. That's the exact same company now calling itself New Bird AI, an AI-native cloud provider. The jump from sustainable footwear to complex cloud infrastructure it's jarring. It's the kind of thing that should make any investor just slam on the brakes and ask, wait, what is actually going on here? And here is exactly why we're talking about it. That little pivot, once it was announced, led to a staggering 700% surge in the company's stock price in one day. This has nothing to do with fundamentals. It's all about the narrative. It's a story so powerful, it can literally conjure up hundreds of millions in market value out of thin air. We're going to call this the AI pivot tax, this massive premium people are willing to pay for a story, not a real business. But, what happens when that story starts to fall apart?
So, here's our game plan. We'll kick things off with the AI shoe company itself. Then, we'll see how this is just history repeating itself. After that, we'll dig into the anatomy of these hype spikes, expose the psychological traps that make them work, and then wrap up with a solid checklist to help you spot the next big pivot before it's too late.
All right, Section 1, the AI shoe company. Let's really get into the weeds of this whole New Bird AI story.
Okay, just look at these numbers for a second, because they tell a wild story. First off, the brand itself was devalued into the ground. The whole shoe business, the IP, the assets, sold for just about 37 million euros. That's a 99% collapse from its peak valuation. So with that, they managed to secure about 47 million in new financing. But here's the part that's just insane. The market's reaction? It added 122 million euros to the company's value, overnight. All for a plan to jump into a market where just getting started costs billions. The math? It just doesn't add up. It's not even close.
And this really gets us to the heart of the matter. Analysts immediately flag this whole story as unsubstantiated. A 47 million euro budget to go up against giants in a field that requires billions in capital just for the basic hardware and data centers? That's not a business plan. It's a rounding error. It's a huge signal that this pivot is all about grabbing headlines and market hype, not about building a real sustainable company.
Now for Section 2, History's Echo. And as you're about to see, this trick is not new. Not by a long shot. This is just the latest version of a very, very old playbook. The technology always changes, but the core strategy, it stays exactly the same. This timeline just lays it all out, plain and simple. Back in 1999, all you had to do was slap a .com on your company name and your stock would go through the roof. Then in 2017, remember this? A little beverage company called Long Island Iced Tea Corp changed its name to Long Blockchain Corp and its stock tripled. The 2021 meme stock craze was all about charismatic stories completely ignoring terrible business fundamentals. And now? Well, the prediction is that by 2026, the .ai rebrand will be the move of choice for failing companies trying to suck in one last wave of cash.
There's actually a great term for this: corporate alchemy. It's this idea that you can turn lead into gold, trying to magically transform a dying business with basically no future into a hot speculative tech stock. The whole point is to exploit that massive gap in how the market values, say, a struggling shoe company versus a supposedly cutting-edge AI firm.
And here's some really crucial context. Even when the tech itself is totally revolutionary, most of the early companies go bust. The internet absolutely changed the world, we all know that. But the dot-com bubble still wiped out thousands of companies and vaporized 80% of the Nasdaq's value. Remember Netscape? They were the market leader, the pioneer. The fact that many people today have never even heard of them just proves the point. Even in a real revolution, the early hype-driven companies often just end up as footnotes in a history book.
Okay, on to Section 3, the anatomy of a hype spike. Let's get a little technical now. How do we actually spot these moves on a chart? we need to learn how to look for the footprints that the big money leaves behind.
We can actually borrow a concept from the legendary trader Jesse Livermore. He called it the pivot point. Now, this isn't the company pivoting its business. This is the stock price pivoting on the chart. It's that exact moment when a stock that's been going down, 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 suddenly reverses course and shoots up. And what's the key signal? A massive, undeniable spike in trading volume. And why is that? Because it takes a ton of money to reverse a stock's trend, and that usually means the smart money is finally making its move.
So what are the telltale signs of the pros stepping in? Well, it usually happens in 3 stages. First, you'll often see a bit of a run-up in the price. Then, and this is the most important part, the volume just dries up. It goes dead quiet. Think of it like a sponge that's been totally squeezed out. It means anyone who wanted to sell has already sold. The supply is gone. And then, bam, the pivot. The stock breaks out on a huge volume spike as all these institutions rush in to buy the few shares left, and that's what causes that explosive move higher.
This chart really makes it easy to see. On the left, that's your average daily volume, just the normal, everyday chatter of the market. But on the right, that's the pivot day. The volume can spike 500, maybe even 1,000%, sometimes more. That is not a bunch of small investors all getting excited at the same time. No way. That is the unmistakable footprint of large institutions getting into the game.
Which brings us to Section 4, the retail liquidity trap. This might be the most important part of this whole thing because it's all about human psychology. That technical footprint we just talked about, it's not just a pattern on a chart. It's designed to be a trigger for our own biases. So why do these things work so well? Why do we so often rush in right at the moment the smart money is desperately trying to get out?
So let's just ask the question head on. With all the information in the world at our fingertips, why is it that retail investors so often become what they call the exit liquidity? You know, the ones left holding the bag when the hype dies and the price inevitably collapses. Well, the answer is buried in a set of very predictable, very human behavioral biases.
These are the 4 big ones. First, you've got herding. We just feel safer moving with the crowd, even if that crowd is running straight for a cliff. Second is regret aversion. It's that awful feeling of watching from the sidelines while it seems like everyone else is getting rich. Then, of course, there's good old FOMO, the fear of missing out, which social media and finfluencers amplify 1,000 times over. And finally, there's priming. We're just bombarded with news about AI all day long, so our brains are primed to jump on any opportunity that has AI in the name, often without a second thought.
The legendary Charlie Munger, he just nailed another one of these psychological traps with this quote. See, once we buy a stock and we start telling our friends about it or posting about it online, we are psychologically just pounding that belief deeper and deeper into our own heads. It becomes part of our identity, and that makes it incredibly hard to step back, look at the facts objectively, and admit we might have made a mistake.
And this, right here, is the brutal, unavoidable truth of these situations. The entire reason for creating all this late-stage, retail-driven hype is to create a market, an opportunity for the early investors, the insiders, and the debt holders to sell their shares into. The pump is literally designed to create the liquidity for the dump. That final, massive surge in price and volume, that's their exit door.
All right, Section 5, spotting the 2026 exit. So how do we actually protect ourselves? We're going to take everything we've just learned and boil it down into a simple, actionable checklist you can use to spot these desperation pivots.
Here it is, just 4 simple questions to ask yourself. Number 1, is the pivot coming from a position of weakness? I mean, a 99% brand devaluation? That's a definite yes. 2, is the pivot unsubstantiated? Is it just a name change? For Newbird, with no data centers and no AI team, that's another yes. 3, how are they funding this? Convertible debt is a huge red flag. That's debt that can be turned into stock later, which can flood the market with shares and just crush the price for everyone else. And 4, and this is the most critical, is there a real path to profitability for shareholders? Well, if you dug into Newbird's filings, you'd find a plan of dissolution. That's an official plan to just liquidate the whole company if this Hail Mary fails. That is not a business plan, it's a pre-planned escape hatch.
And that brings us right back to this idea of the AI pivot tax. It's the price you pay when you buy into the hype late in the game. That tax doesn't go to building a business. It goes directly into the pockets of the people who are selling their shares to you. Put simply, the pump is the tax that pays for the dump.
So we'll end on this thought. The playbook is out in the open now. The patterns repeat themselves over and over. The next company that's getting ready to pivot from its failing business to a hot new AI story, it's already out there. It's trading on the market right now.
The only question is, after walking through all this, will you be able to see it coming?